Is Ethereum back on top? Ethereum is on a tear. Not too long ago, people were calling it old news as attention shifted to Solana and other rivals. But sentiment has flipped. Billions are pouring in through newly approved ETFs, and fresh highs are suddenly back on the table. It's exciting, but it also raises the question, haven't we been here before? I'm Bola, and we're back in the Binance Studios with another video on why Ethereum's latest rally could have staying power. All right, so let's rewind to 2021. Ethereum was at the center of the NFT craze and the DeFi boom. Every trade, every mint, every app needed ETH to run. Demand went crazy, and together with the wider bull market, it pushed ETH to nearly $4,900. But those highs were built on shaky ground. The network was overloaded. Gas fees spiked, and sometimes it costs more to send a transaction than the transaction itself. Sending $20 of ETH could mean $30 to $50 in fees, and people were burning hundreds just trying to buy NFTs. Regular users were priced out. Speculators took over, and when the hype cooled, the bubble burst. Ethereum crashed along with the rest of the market. But while prices were down and headlines were negative, Ethereum's developers kept building. Quietly, they laid the groundwork for what we're seeing now. The first milestone came with the merge in September 2022, when Ethereum switched from proof of work to proof of stake. Before, it relied on miners like Bitcoin. After the change, people staked their ETH to secure the network instead. Energy use dropped by 99.95%. It was like swapping a gas-guzzling engine for a hyper-efficient electric one. And just as important, new ETH creation was cut by nearly 90%, meaning far less supply entering the market. At first, staking came with a catch. Once you locked up your ETH, you couldn't withdraw it. That changed with the Shapella Upgrade in April 2023. Suddenly, staking became flexible. People could enter and exit whenever they wanted, and participation surged. Today, nearly a third of all ETH is staked. That's a massive chunk of supply taken out of circulation. Then came the scaling breakthrough. For years, high fees held Ethereum back. But in 2024, the Dencun Upgrade changed everything. It gave other networks a cheaper way to settle transactions on Ethereum. Fees dropped by more than 90%. What once cost hundreds of dollars could now be done for pennies. For the first time, Ethereum was practical for everyday use. And that set the stage for the next big catalyst: institutions. In 2025, major US spot Ethereum ETFs went live. For the first time, the biggest investors, pension funds, and asset managers had a regulated way to buy and hold ETH. Within weeks, billions poured in. But maybe the bigger shift was perception. Ethereum seemed to no longer just be a speculative play. It was recognized as a serious asset class for long-term growth, part of the financial mainstream. That trust and awareness is a big part of why Ethereum might be different today. It's the leading smart contracts platform, securing more value than any other blockchain. It's the backbone of the stablecoin market, where USDT and USDC now move more than Visa and MasterCard combined. And traditional finance is moving on-chain too, with BlackRock running a multi-billion-dollar tokenized US Treasury fund directly on Ethereum. Even NFTs and blockchain gaming are showing new life, with fees now low enough for everyday users. Developers and brands are building again. So, when you look at Ethereum's latest rally, there is plenty of evidence to show that this isn't just a repeat of 2021. Big numbers grab attention, but it's the fundamentals that matter. Prices will rise and fall, but the network is stronger than ever. It's more efficient, it's cheaper to use, supply is tighter, and adoption is real. That's why many believe Ethereum's long-term path is looking more sustainable this time. What do you think? Is Ethereum truly back on top? drop a comment and hit subscribe because this story is just getting started and you won't want to miss what comes next.